Well, good evening, everyone. This is AJ Monty with the Market Guys, and it is 8 o'clock Eastern Time, and we're going to start our Q&A session, which, by the way, does include the rapid-fire stock analysis section. So if you're brand new to a Market Guy web seminar, be ready with your stock symbols. Don't put them into the Q&A box just yet, because we have a scrolling box there. So as people type in, your symbols will eventually just scroll off the screen, and I won't be able to see them. However, when it comes time to submit a question, I'll prompt you on that, and then I'll go and I'll look for your questions, and I'll do the same for the stock symbols. Right now, on the screen, I have a 10-year monthly chart of the diamonds. That's the Dow Jones Industrial Average ETF, ticker symbol DIA. And I've left my lines on the chart from the last weekly market report that I did because I really want to show you the position that the market is in right now with regard to it being so overextended. Now, the term overextended is also synonymous with being overbought or overvalued. These are some of the terms that analysts will use when describing a market like this. And as I zoom in to the chart, you'll see that these vertical lines here are the short-term trend lines that I drew for these upward legs. Now, again, I'm using terms here that it sounds normal to me, but I have to always think, who's in the audience right now that doesn't know what I'm talking about, and I have to monitor my own language because I tend to use jargon quite a bit. An upward leg is from a low to a high. So this would be, I'll draw one down here as well. I'll just see if I could draw a trend line here for you. And so from this low to this high would be an upward leg. So when I'm drawing trend lines, I try to capture as many of the bottoms or lows that I possibly can, and I extend upward and outward there. And you can see that back here, this was the month of, what month was that? That was March of 2009. This was, again, after the sell-off of 2008. We had a tremendous bounce, and the market, month after month, continued to go higher. And this is typical of any kind of a corrective move or a bounce after a sell-off. And you'll see that this upward leg was followed by a short-term downward leg. And it doesn't look like much here because it's only maybe 4 months where the market sold off. But if you look at the diamonds, that's when we were trading right around 11,500, and it went down very close to 9,500. So in that short period of time, the market dropped almost 2,000 points. And again, it doesn't look that severe because you don't see a drastic sell-off as compared to the upward leg that we had. Now, not too long after that, in July of 2010, we went into another upward leg followed by a downward correction. And then again, this cycle continued, and you can see that the steepness of these trends are something you have to pay very close attention to, because when a market goes up so steeply, it generally means that there's a corrective or a correction that's going to follow, and it's usually takes place when the trend line is broken. You see, back in this upward move, the trend started to shift when the prices started to drop below those trend lines, and the same thing happened here. This was actually a very severe correction. That's when the Dow was up there around 13,500, and then it dropped all the way down to 10,500. So this was a 3,000 point drop in the Dow after it pulled back over 50% of that upward move. And again, here's another upward move followed by a 50% correction. So, for weeks now, I have been putting out the caution flag to people. I've been really just putting out strategies for managing risk. And I talk about taking profits, and I talk about sell stops, and I talk about options and such. And it's very difficult sometimes to be an analyst that is talking defensive strategy when the market has been going up so steadily because people are looking at me and many of the other analysts and they're saying, why are you guys being so negative? You know, you're gonna turn the market around on us. You know, leave a good thing alone and let us continue to make profits. And if that's, you know, if that's the boat you're in right now, then go for it. Keep your profits intact. But I still say it's a great strategy. It makes common sense to at least protect your positions. So when you see the Dow following such a regular upward trend, I mean, look how beautiful this upward trend is. Each and every month, it seems as though the month had bounced off of that trend line, and here we are at approaching the end of May with a fairly strong green candle. Now, we only have about another week and a half before this month is over, and I'd like to point out to you what we're seeing on volume. You see, here we are a week and a half and to go in the month, and the volume is just below half of the volume that it was last month. So when you have a series of 1, 2, 3, 4, 5, 6 months in a row where we've had higher highs and higher lows, you have 6 months of that, and the volume has been increasing each and every month. What happens when all of a sudden the volume dries up? And that's exactly what's happening right now. The month of May, although it's a strong green looking candle here, the volume is 50% from what it was last month. And that tells us that you have to be defensive, because when the volume drops, it means that the buyers are no longer buying with that enthusiasm that they did the months before. So there's your first signal of a possible reversal in the trend. Now, what I'm going to do, and I don't want to dwell too long on this, but I think it's very important, here we had a resistance area that was broken. This resistance area was established in September of 2012, and it wasn't until January of this year that we actually broke through that resistance area. Now, if you've been following the Market Guys philosophy and the strategies for the Market Guys, there's a thing called roll reversal, and I'm going to go to the website here so you can see. If you look at the Market Guys website, just go to marketguys.com. There's a video link here, and there are what we call market shots. These are 4 to 5 minute videos that I've produced, and Bill has put this on the website so you could get this, you know, short lesson in what we're talking about. The roll reversal right here is something you definitely want to study. This will be the best 3 minutes of education you're going to get, because it explains in detail what a roll reversal does, and more importantly, it shows you how to use the roll reversal as a defensive strategy as well as an area to enter the market. You can pick your entry points as well. So the general idea of a breakout is that the market will tend to continue in the direction of the breakout, but eventually what happens is the market pulls back to the original breakout point. So if I take this high and I just draw a downward leg, this is generally what you see in a corrective move. See, here I am expecting the market to pull back to the former resistance, which will then be a new support level. Now, that is right around the 13,500 level. So you're talking almost, almost a 2,000 point correction is possible once this upward trend line is broken. So we really have to keep our eyes very closely on this line. And what you also want to watch out for in June is we want to see if in the month of June we break out into a new high. Let me erase some of these lines so I could show you what I'm talking about here. If you again understand what an uptrend is, an uptrend is higher highs and higher lows. Again, here's a higher low from the previous month. Here's a higher high from the previous month, and that follows in every month for 6 months. So here we have a higher high than the previous month of April, and here we have a higher low than it was in April. If in the month of June we are not able to set a higher high, so in other words, if in June the high only comes to, let's say, this level, that is a major, major signal. So we have to make sure that if this trend is expected to continue, we have to set a new high next month. If we don't do that, then I'm going to get even more aggressive on these defensive measures and waving the caution flag than I have in almost the whole year. If we don't set a new high in June, watch out below, because that is it's called a half signal. If you have a lower high but still you have a higher low, that is a half signal, and that's usually the beginning of a downward trend. Here's a half signal. See back here, you see we had a lower high than the previous day, and then we had a lower low. So here's the beginning stage of a pivot point. You can see that here was a lower high and a lower low. This is a full pivot point. It's not a half signal. But if this had been a lower high, even if this was a lower low, that would have been a half signal. But here we had a full pivot point and a breakdown below that trend line. So again, that's the lesson for today. Before I get into the stock analysis, I just want to show you exactly what's happening in the market so that no one's surprised by, oh, why didn't you tell me the market was going to turn around? Now, if you look at the Russell 2000, this is an even more dramatic upward leg. And it's highly irregular, or it's highly unusual for us to see upward legs with such steep angles. Again, here's what I'm doing. I'm taking that low, and I'm trying to connect as many of these lows as possible, with the exception of this one here. You can see I'm connecting as many lows as possible, and this angle is very, very similar to what we've seen before in these upward sloping legs for the Russell 2000. Now, going back to this leg, which began in 2004 and ending right here, right around 2008, this is a 4-year. Remember, this is a monthly 10-year chart. This is a 4-year upward leg. And of course, we know what happened in 2008. That was the big crash or correction. But look at the steepness of the most recent trend. It is right there, what we saw back in the beginning of 2009, ending in 2011. The angle at which the prices are accelerating is almost identical to the degree in that we're seeing here. And again, the Russell 2000 had a very, very steep sell-off once that trend line was broken. So again, I am expecting eventually, like all trends, they do come to an end. I do expect that this downward break will take place probably in the next month or so, and I'm going to continue to monitor that each and every week through the weekly market report. Now again, if you're brand new to the market, guys, let me go to the front page of our website so you know where to get the weekly market report. Number one, we do not sell our email addresses, and you can see I'm not asking for any phone numbers. You only need a first name. You don't even have to put your last name in there. We just need an email address so that we can send you the weekly update. It is free. You could also pick up the weekly video report from the front page here, and that's the way to do it. The other thing that you can do is subscribe to the Market Guys Facebook page, and I will notify you when the weekly market alert is, or the weekly market report is posted, and then you can do it that way. So again, these are all free avenues for you to pursue to get the updates, and my goal is to continue to educate the market so that we are not caught by surprise, and my goal is to keep people from suffering catastrophic loss when the market eventually turns around. We want to be able to maximize our profits each and every week and even every day so that, you know, we're not getting on the wrong side of the market. Okay, now Gil put a statement out. He mentions the VIX. He says, but for now, VIX is still calm. Let me go to the VIX. Now I'll be getting into the market, the stock analysis here shortly. The VIX is a contrarian indicator, but you have to understand the VIX is nothing more. It's like a seismograph. You know, it measures the shock waves in the market, it measures the volatility, it measures the emotional premium that we see in the S&P. And when volatility is low, that is generally a signal that we're reaching market tops. Now again, if you look at the 10-year monthly chart, this level just below 10 is it's the all-time low for the VIX, and we hit these levels below 10 just before the major sell-off in 2008. And what happened is we started to see bullish engulfing patterns on the VIX. There's one right there, big green candle engulfing the previous red candle. There's another bullish engulfing pattern almost back to back where it engulfed the previous red candle. And we see very interestingly enough, we saw a bullish engulfing pattern back here, but it was followed by a bearish engulfing pattern. It's very, very strange. You don't see that too often. But what that means, when you have a bullish engulfing and bearish engulfing, it means that volatility is starting to heat up. It's almost as though the VIX is undecided. We don't really know, but it does tell us, because it is very close to 10-year lows, that the market is fairly relaxed, that investors are pretty much content with the profits they're seeing right now in their account. And believe it or not, sell-offs usually occur right after this state of complacency. When everyone is feeling relaxed and feeling great about this great ride in profits, that's when they start to say, whoa, maybe I should start taking profits here, because there's no new buying coming in to stimulate the volatility, so the market tends to drop. And that will also be the case for institutional buyers. They pay very, very close attention to the VIX. When the VIX is on the low, we are generally reaching market tops, and when the VIX is at highs, especially over 45, then we are generally reaching market bottoms. So we are really stuck at the bottom of this trading channel, and Gil is right. The VIX is still pretty calm right now, and it's still at the 10-year lows. So keep an eye on the VIX, because that's usually a leading indicator of things starting to pivot and go the other way. Okay, it's 8:17. How about we start looking at some of your stocks? How about that? So if you'd like to start submitting some stock symbols in there. Let me see. Ron says, what's the projection for ABX? And I'm only going to take one stock. If you submit two, I'm just going to take the first of your two, because I have to try to get as many in as I can. ABX, if you look at this is a monthly chart. I'm going to stay on this one for a while. This is Barrick Gold. I am extremely bullish on Barrick Gold right now. And you know, you have to see this, Ron, that here is again a 10-year chart of Barrick Gold. And we just recently, last month, we bounced off of a key support level right around 17.5. And now, in the month of May, we have a very small bodied candle. Now, what does that tell us? Let's analyze this. 1, 2, 3, 4, 5, 6, 7. We had 7 months in a row of lower highs and almost 7 months in a row of lower lows. This is the half signal that I mentioned before. We don't have a higher high, but we now have a higher low. And if you look back at the last time Barrick Gold did that, we had a higher low, not necessarily a higher high, but we had a higher low, and that was beginning stages of the pivot point. That's number one. Number two, look at the volume on Barrick Gold. Last month, we had record volume in the 10-year period. That was the highest volume we had in 10 years. Most of that was driven by the news out of Cyprus that they were selling their gold, which, by the way, they didn't do, but it was the news that drove that lower. Now, we have volume that is just about half of what it was last month, and we have a higher low. So that tells me that the sellers are starting to slow down. The other thing that really attracts my attention to Barrick Gold is you have to look at how far this stock has moved from the moving average. In 10 years, this is the furthest the stock has drifted from the 20-month moving average. This is the furthest it's gone away. So the divergence here is quite wide. For those of you who have been following my analysis, you'll know that I talk about the rubber band theory. It's not something that I believe is published outside of out of my book, but I do talk about the rubber band theory being one end of the rubber band, if you can imagine an imaginary rubber band here. One end of the rubber band connected to the moving average, the other end connected to the stock. That rubber band is being stretched to the max right now. So even if Barrick Gold gets up halfway, if it even recovers half of this, we're still talking almost a $10 move. That's a 50% appreciation in the stock price if it just recovers the downward leg here. So I'm very, very bullish on Barrick Gold, and even with me being so bullish, you still have to protect yourself. So if you decide to buy Barrick Gold below 20, you have to put a sell stop somewhere below 17.5. I would say around 17. So that would be a $3 risk per share. For the traders, here's a great candidate. For the option traders, same thing. You can find bullish strategies by selling puts, buying call spreads. For the long-term investor, I mean, this is the kind of stock that I'm touting because it's a stock for everyone. Every investor, trader, option trader can find something to do with Barrick Gold right here. And it doesn't mean you have to sell out of every other position to get in. You could just take a comfortable position and sit with this one, and I think it'll do really well. So that's my spin on Barrick Gold for you, Ron. Hope that helped you out. Now, Paul Farley has 500 shares of WETF at 12.5. So let me put that in, WETF at 12.5. This is Window Tree Investments, and again, this is a monthly chart. So, Paul, I mean, I'm looking at this, and just like the rest of the market, this doesn't have that much history to it. It doesn't have 10 years of history, but you have 6 months of upward movement here in a vertical direction. So here we go. Look at that. I mean, what's your strategy there? You're going to continue to hold on? Well, that's the monthly chart, but let's go to a weekly chart. Let's try to zoom in a little bit, and you can see that on the weekly volume, the volume is drying up here quite dramatically. Now, granted, it's only Monday, so we still have 4 more days of trading to see what's going to happen, but it doesn't look as though the volume is going to surpass what we had 2 weeks ago. The other thing you have to watch out for, Paul, and you tell me that you don't have a stop in place, but I would actually be taking my profits right now. To take $1 profit on a $12.5 investment isn't so bad, but I would be taking profits because the shadows, which are the vertical lines protruding from the top of these candles, are starting to get longer. And when the shadows get longer up top, it means that the buyers are trying to push it up, but the sellers are coming back with force. So there's the weekly chart. I'm going to zoom in 1 more degree and go into a daily chart, and you can see that today we had a spinning top. Spinning tops are a sign of indecision. You had a bullish engulfing pattern here, and again, even on the daily chart, the shadows are starting to get pretty long, and so I think that this stock could pull easily back to the $12 level, which would be the moving average. So that's what I would say for WETF, Paul. Hopefully that helps you out. Now, let's see. Gerald says, thinking of buying equal amounts of DXJ and XLF. What do you think of these? And if you approve, when would be a good time to buy? Well, let's start with the DXJ, Gerald. And again, it's very, very hard for me to take long positions in anything really right now because I do, like I said before, I do think that a correction is long overdue. Now, this is more of the Japanese. This is a Japanese equity fund, and if you look at this one, there are a series of gaps. Now, this one has a tendency of gapping, so I can't say all gaps are going to fill with this one, but there's some major gaps that look pretty interesting here because I think these 2 gaps alone could very well wind up being filled. This is a major gap. This is called an island. An island is when it gaps down, and shortly after that it gaps up, and it leaves this, looks like an island. If you look in the map, that would be an island formation. And again, if I go to a weekly chart, this is going to be a lot more severe in the upward trend. Look at that. So when I see this, again, it's really hard for me to buy any of these, because this is it's like a rocket ship had taken off, and the stages are separating, and we haven't had a pullback yet. But it's evidently this one has been going for a long time, like the rest of the markets. But you got to keep an eye on the volume on this one, and I just see too much divergence between the moving average on the weekly scale. I see gaps on the weekly chart. You saw the gaps on the daily chart, but it looks to me like the weekly gaps going back at least 3 years, it looks like all of the weekly gaps have filled in the past, except these latest three right here. 1, 2 here, and then 3 up here. So I would have a really hard time buying it. I'm not even going to think about making a recommendation on that one to buy. So be careful of that one if you decide to go with it anyway. Okay. Stocks, if you could maybe submit them again, please. They scrolled past me. Let's see who's the next one. All right, James. I'm going to pick you there. James said, what do you think about eBay? I'm going to go with eBay, even though you had two of them in there. I'm going to go with eBay first. And you bought a long put on eBay. Okay, here's the weekly chart. I would agree with a long put position because of a couple of reasons. I'll zoom in here for you. Here we have it looks like the beginning stages of a head and shoulders pattern. Let me draw this out for you, because head and shoulders patterns usually takes about 2 to 3 months to actually form, and I'll draw this out for you. Here's an upward leg. Here's a downward leg. Here's another upward leg. Oh, let me draw that for you. Here's another upward leg. And then here's downward leg. Upward leg. Draw that for you. Right there. And it looks to me like the downward leg is starting to form because you have, again, a half signal. This week, again, because it's Monday, that's going to be a red candle because it's down today. But you have a lower high from last week. First time that's happened in 4 weeks. And we don't have a lower low yet. So if you are looking at head and shoulders patterns, or you're looking to study that, or maybe you're being exposed to this for the first time, go to the Market Guys website, click on videos, go to the market shots, and you will see that there are head and shoulders pattern, a head and shoulders top. Click on that one, and you can get a 3-minute education on what a head and shoulders pattern is. This left pivot point here would be the left shoulder. The middle pivot point would be the head. Now here's the key. This is what you have to watch out for. Most of the time, the right shoulder, which is what we're seeing right here, most of the time the right shoulder will be lower than the head. And what we're seeing here is a neckline that would be drawn from these lows. So here's the pattern. Oh, let me get rid of that. My pen stuck there. You have a left shoulder, head, and it looks to me the right shoulder is forming. If it breaks down below the neckline, watch out below. This thing's coming crashing. So eBay, you really have to watch out on this. So James, I totally agree. I'm buying the put, but as the big but, I don't think buying a July put is the best way to go. Here's why. Number one, maybe you could put in what strike price you bought in, but one of the biggest mistakes people make is they buy the front month options because they're cheaper, and people tend to buy out of the money options again because they're cheaper. The best way to go for eBay is to buy a long-term in the money put. Let's see if James put a response in there. James, I know there's a little bit of a delay, but if you could tell me which strike price, that would help me help you better. I'll wait to see if there's a comment that comes in on that. Don't see it just yet, but let's go to the daily chart, and I'm going to leave the lines that I drew on the weekly chart in place. Okay, you have a beginning stage of a pivot point here. You have a lower high on the daily chart and a lower low from the previous day with an inverted hammer at the top. Again, this is looking pretty bearish for eBay. and I would go with that put. Now, James, you bought the July 57 put. Okay, so at least you bought one that's in the money. The thing that I have to tell you that's going to really help you is you don't have the luxury of being able to hold this one very long because it is a July option. And what's going to happen is now that June is the front month, you will start to see time erosion on the July options as well. So if I would say that if eBay gets down to the 54 level, which is right around where the moving average is going to be, I would probably look to take your profit and move out of that one, because what could very well happen is the stock could go to that moving average and just kind of die right there looking for a secondary bounce. So be really careful. If it breaks down below the moving average on good strong volume with bearish candles and such, then I would move out to a further month out. I would even go into the July 15, the July 2015 options. That would give you a better chance. 2 days ago, 2 trading days ago, there was a bearish engulfing pattern. I'm wondering if that's the day you got in on that, because that would have actually been the signal to do that. Okay, hopefully that helped you out, James. All right, let's see. Scrolling ahead. Brian says, Facebook, FB, thinking to buy on next green. Stop loss would be at 25. Let's take a look at this one. Facebook. Facebook has come a long way. I mean, here's, let me go back to, actually, I'll erase my lines here because we've analyzed Facebook so many times in the past, so I didn't delete that. Let's go to a weekly chart, and here's Facebook from the very beginning, since the IPO back here. There's good and bad about Facebook. The good thing is it looks as though it's found a level of support, okay, right around the 25.5 level. The bad news is, again, this is a weekly chart. 3 weeks ago we had a bearish engulfing pattern and it dropped below the 20-period moving average. So that's the weekly chart. So, Brian, what you have to watch for if you're thinking about buying it is, number one, you want to wait for a weekly green candle somewhere above that support level, right above 25.5. You want to see a green candle. Do not, repeat, do not try to buy Facebook when the weekly candle is red. That could be a disaster waiting to happen for you, because if you try to buy it just because it's going near support and the candle is red, that means the sellers are still in charge while it's on the support level. So if the sellers are in charge and they get excited and continue to sell, a breakdown in this support level, remember, this support level has been tested 3 times already, a breakdown in that support level could wind up bringing that stock all the way down to $19. And that would hurt, because if you bought it at 25, 26, and now you think about selling it at 19 because you made a mistake, that percentage-wise, that would be a disaster. So be careful of that one. I wouldn't even look at the daily chart on this one, Brian. I would wait for the weekly chart. It's going to help you with patience. Remember, if the general market, the S&P, the Russell 2000, the Dow, if the general market, the broad-based indices are looking overextended, even if Facebook shows positive buy signals now, the general market sell-off could wind up pushing Facebook down in a domino effect or a sympathy sell-off. So again, cash is a really good position right now. It's really, cash is an opportunity waiting to happen, and when the correction takes place, the people who have cash on the sidelines, they'll be the ones that will be able to really go out there and to capture the opportunities on those sale days. Okay, I'm looking at the clock. Wow, almost 35 minutes into the session already. Can't believe it goes so quickly. Ken, I'm coming in for the rescue, man. I see you typed that in like, what, 7 times? I'm going to look at CI for you, okay? Ken Wolf. He is looking at CI. He's long it at 65. Let's take a look at CI. Let's go. What's CI looking like? Cigna. You long it at 65. It's trading right at 60, just below 67. Red candles there are telling me watch out. You got a steep angle. You got that trend line that's running parallel to the 20-period moving average. That's the weekly chart. Let's switch to the daily chart and see where we stand on that one. Yeah, Ken, I would be selling this one. I would be selling and taking your profits. Here's why. I'll zoom in here for you. You have a close below the 20-period moving average. This is the first time it's actually closed below that line since back here in February. And you know, the stock came really close to closing below the moving average a couple of times, but this is the first time it's actually done that. I'll zoom in here for you so you can see. All right, this one just flirted with it. This one, I think, closed on it. This one definitely closed below it, and it looks as though this one could go lower. Now, if you long it at 65 and it's trading 67 or just under 67, not a bad profit. You know, take your profit while you have it. My philosophy is that you never want to turn a winning trade into a losing trade. You know, just because you have a $2 cushion doesn't mean you have the luxury of being able to hold this one. Because what will happen is, if this trend line is tested, that's going to bring it down to close to 64.5, and now you're down on the trade. So I would take the profits, wait to see what happens when it pulls back. If it bounces off of this trend line and does something like this, then on a green candle, you know, you could get back in and then put your stop somewhere below that trend line. So that would be the best thing for you to do at that point. I'm again big fan of taking profits when you have them, especially when the signals are negative. Okay, Dylan, I'm going with Dylan because Dylan is short TSLA. Dylan, can you please tell me where you're short the stock? TSLA is whoa, beautiful short candidate. I love that. Look at that. If I go to a weekly chart, you're going to see something incredible. Whoa, look at that. There's not too many stocks that you could say are that vertical, and yeah, stay short it. I mean, I tell you, this is one trading 89. The volume, what I expect to see now, because again, as I zoom in, here's a great lesson, folks. Let me get rid of all the other lines. This is a great lesson on short selling. Now, if you have never shorted a stock in your life, pay very close attention to this one right now. It's not a complicated strategy. It's not rocket science. The short strategy is nothing more than an idea of making money when a stock drops. That's all it is. Most people, they think, oh, I'm going to buy low, sell high, because that's how we're conditioned to think. You know, buy low, sell at a higher price, you make money. Well, it doesn't matter which order you do this in. If you think a stock is going to drop, you could sell a stock and actually collect money from the sale. Even though you don't own the stock, your broker will loan you shares to sell. They take it out of their inventory, they loan it to you, you sell it, and you take money in from the cash. When the stock drops, what happens is you buy the stock back at a cheaper price, and then you give them their shares back. That's all it is selling borrowed stock. It's like selling stock on consignment. That's all this is. So I really like this one, Dylan, because you can have a half signal there. You have a lower high on the weekly chart. Again, remember, it's only Monday, so you still have the rest of the week. So you have to be patient with this one. But you also, on the weekly chart, you have a gap down here, which this stock does not gap all that often. So Dylan, I mean, that's where I would put my target price, actually. I would put my target for right around 40, which is where that gap would be filled. So if you have shorted it anywhere near 90 and you buy that back at 40, you're going to have a home run. That's a big money maker if, in fact, the stock corrects like I think it will. Now, with that said, Dylan, I'm going to put you on the spot. Where did you, all right, you shorted it at 86, all right, so it's going against you a little bit. Where did you put your stop? Let's put you on the spot there, and I'm going to wait for that answer, because if you short a stock, your risk is to the upside. So you have to put in a buy stop if the stock breaks out over this high. So here's what you have to do. As painful as it might be, if the stock gets over the $97 area, you need to buy that back. and close the position. So Dylan has a stop at 95. Well, I like the idea that you have a stop in, but actually the stop is too low. You have to put it above resistance, not below resistance, because this stock could very well go right up to resistance, hit 95 and come back down, and that stock is still a short candidate. So yeah, keep that in mind. You might want to raise the stop over 90, the 97 level. Now, if you're saying, well, that would cost me too much money, if if it goes up there, it's going to cost me, I don't want to lose that much. Well, then you might have to reduce the number of your shares on the short position to be able to put the stop in the correct place. Okay, so let's see if that helps you out. All right, Paul. Paul says, next stock, CMCSA, looking for an entry point. Again, I'm assuming you are looking to buy the stock, so I'm going to come in here and analyze that for you. Again, this is a weekly chart. The uptrend is following the 20-period moving average like clockwork. Number one, the weekly chart is showing red, so you don't want to be buying that. So now we have to go to a daily chart, see what that looks like. Daily chart is showing red. Uh-oh. Paul, watch out. Let's see. I'm going to put the audience to the test. All right? Let's see. Follow me here, because this is the big test question. I'm going to give you the scenario just like I see it. You see, you have a lower high, lower low 3 days ago. Another lower high, lower low, and today another lower low, lower high, and the volume is increasing. That's what I see. I see the volume increasing. I see the stock stopped right at the trend line. And the question is, for the test, the big bonus question is, what is the significance of increasing volume on red candles? What does that mean? You can put that in any language you want, but when the volume is going up, when the price of the stock is going down, what does that mean? Let's see, who's going to answer that first? The sellers are in control, right? That's right, Gil. Kelly says the same thing. Sellers are still in control. Paul Farley, same thing. Sellers are in control. JMCV is saying the sellers are dominating. Yeah, absolutely. That's exactly what that means. So if I see a stock being controlled by the sellers and it's right on the support level or trend line, I want to stay away from that until I see the buyers in control. So if you're looking for an entry point on this one, I would look for a green candle above the low here. So it would be a half signal, a higher low. Doesn't have to be necessarily be a higher high, but it has to be a green candle with a higher low, and it has to be over the line. So that's the only way that I would look to buy this stock. If the green candle shows up tomorrow and you decide to buy it because it has a higher low and it's above the trend line, then you need to put your stop somewhere below 41 so that you're protecting yourself in the event the stock breaks down below that trend line. So that's the simple way to look for an entry point in a stock that's trending higher, and that's the best way to protect yourself is by using the trend line to guide you with the sell stop. I hope you're getting a lot out of this. Some of you have been with me for a while may have noticed I slowed the pace down a little bit, didn't I? I'm not analyzing as many stocks like I did before, because I'm slowing it down because I want to make sure everyone's getting the lessons behind the signal. Because if you're not following the signal and you're still going on emotion, then guess what? The emotions are going to take over. And emotions, when you're trading with your emotions, that's not trading with your brain, obviously. And the emotions will get you in trouble. The way to remove the pressure, to remove the stress, to remove the emotions from the decision-making process is to actually look at the charts and let the charts tell you who is controlling the stock. That's it. Okay. Martin, excuse me. Looking for an entry point and stop loss value for FIRE, F-I-R-E. What is FIRE? Source Fire Incorporated. Well, here's a daily chart, And I'm going to zoom in here for you. Let's draw some lines. Okay, I'm going to show a price level. All right, here we go. More test questions. Get ready to type in an answer. The line that I'm drawing right here, connecting the highs, what line is that called? 1, 2, 3. Who's going to be the first one to answer? Let's see. Resistance. Yes, Robert, thank you. That is a resistance line. Now, here is a line I'm drawing. What is the significance of this horizontal line that I'm drawing? Who's going to answer that one? Let's see. Here's the hint. I'm circling it. All right. Yes, gap. Thank you, Ken. Thank you, Brian. That gap, yes, when the gap fills, that gap will also act as support. That is absolutely, absolutely true. So we have a stock that is stuck closer to resistance than it is at support. Okay, keep following me here. What is the pattern? These little candles here, these small bodied candles, 1, 2, 3, even back here, what is the term that's used to describe small bodied candles? Close, Ken, not quite. I'll explain the difference in a second. I'm not going to give it away yet. Okay, yes, Kelly, they're called spinning tops. And Gerald hit it on the head. It's a sign of indecision. Spinning tops and dojis. A doji doesn't have any color to the body. It's a cross. There's one. Here, I'll zoom in for Gerald and Gil. Where'd it go? There's another support level. Oh, here's a doji. There it is. There's a doji. See, it doesn't have any color to it. It's a simple cross. This is very close to a doji. These are all spinning tops. When you see spinning tops, which are these very narrow-bodied candles, especially when you see spinning tops at resistance points, that usually tells us that it's a sign of indecision. And when you combine spinning tops with lower volume, you see the drop in volume. It's a dramatic drop. The volume has not picked up in over 2 weeks. So it's telling us that the buyers are running out of steam. So I really have a hard time, again, trying to find an entry point on this one because the candles are also showing shadows above that are long, which tells us that on a day like this one, on Thursday, the buyers tried real hard to push it and keep it higher, but the sellers came back with a force. This also signals that the buyers tried to push it up today and were not able to get it to a new high, and the sellers came back in. I'll show you what that looks like. During the course of the day, the buyers tried to push it higher, sellers came back. Here's exactly what I'm talking about. This is an intraday chart, minute by minute. See, from the opening, which is right here at this line, the opening, the buyers tried to push it up. And what happened? Throughout the rest of the day, the sellers kept pushing it down. So that's very bearish when you see long shadows on top of the daily candle. So again, I can't get myself to even find an entry point on that one until it gets down here to 43, where that gap fills. Let me go back and review for you the Market Guys site so you can see where to get the lesson on spinning tops and dojis right there, right in the middle of the page. This is, again, 3 to 4 minute lesson on what a doji is and what a spinning top is and the significance of that. And also, there is another chart. Where is the gaps? I know it's in here somewhere. I know I had a video on gaps. Anyone see it? Let me see. I know it's in here, trading the gap. We might have another page. I know it's in there somewhere, but gap trading is in there. You have to look around. I'm not going to waste time looking for it unless, Bill, maybe you could send me a text and where that might have been moved. By the way, folks, we're going through a website redesign. So we're excited about that. Get ready to see the new facelift for the Market Guys. We're enhancing the videos. We're putting the television shows that we're doing on there. We're going to make it a little bit more interactive. And for those of you who are brand new to the Market Guys, we do have a mentoring service. If you're interested in that, I am going to be opening it up for the summer. The markets tend to slow down during that time, so I'm going to try to make more time available for anyone that might be interested in mentoring. If you are interested in mentoring, please, all you have to do is go to the Q&A box and say I'm interested in mentoring and put your phone number in there. That's it. No one else is going to see that. If you're interested in mentoring, I'll give you a call probably by the end of this week and we can discuss the details. If you're not interested, no problem. We generally have a line of people who come during the summer because they have summer vacations and they have time to spend with me. So you can look into that. Okay, Bruce, you got the hang of it. CL. Let's see what Bruce is long. Is it CL or GL? It's CL. Bruce is long CL at 40. We're looking at the daily chart. Whoa, you're long it at 40. Okay, Bruce, I'm going to put you on the spot. Ready? Where's your stop loss order? And Bruce, if you don't have an answer to that, you and I are going to have an offline conversation as to why you don't. But let's see where Bruce has his stop loss order. If you buy the stock at 40, now let's imagine we are all Bruce, okay? And let's go to the weekly chart. And let's say we bought the stock right at 40 on that role reversal. Let's say that we're all Bruce and we did that. We bought it right here on that bullish engulfing pattern. And your stock goes into a textbook, upward sloping, beautifully angled upward trend. What is the strategy? Here's another test question for you. All right, Bruce has his stop loss order 59. Bruce, I'd give you a big fat kiss if you were good looking and standing next to me right now. 59 is the perfect place to put your stop loss order, and I'll show everyone why. If your stock is going up and you own the stock, what is the strategy that I would use to protect the position? Hint, a stop loss order would be part of the strategy, but there's a second part of this. All right, Tom, you got it. Paul, you got it. Brian, you got it. A trailing stop. So if you buy it at 40 and the stock goes to a series of role reversal points, and I'm signaling these for you, each and every time a stock goes to a role reversal, here's a role reversal, resistance broken turns to support. Resistance here, broken, turns to support. Resistance here, broken, turns to support. Resistance here, you got the point? Broken, turns to support. Resistance here, turns to support. This is a textbook and very classic step-up pattern. This is when a stock goes into an upward trend and it steps up. Now, I say what's interesting here is that the stock has a resistance point back here at 58.5, and let's see, the stop, as we mentioned, Bruce said he has a stop at 59. He's putting it right at support. You know what, Bruce? I would even say 58, but what's happening is the stock has not pulled back. So I think 59 is still okay for you, because you have a bullish engulfing pattern here, and the bottom of the bullish engulfing pattern is right above 60. And when you have a bullish engulfing pattern that fails, I'll zoom in for you, then it's not quite a bullish engulfing pattern, but we'll call it close enough. I would say a stop below there is okay, because it will establish a new support level. And Bruce, don't worry if you get stopped out. To be able to buy stock at 40 and turn around and sell it at 59, you know, you're a hero. 50% profit, not so terrible, and in a short period of time. So good job on that one. And I like the fact that you gave me an example for a trailing stop. All right, I'm going to take. I'll take one more stock. Who's the next one? Next to type in gets it. All right, let's see. Next one. All right, Edivaldo, you're the winning candidate. Question submitted by Edivaldo is, what do you think of the movement on GLD and SLV? Well, I did say I'm going to analyze one, but I'm going to group these two into the precious metals category here. Let's go with GLD. And remember, we looked at ABX. If you remember, we looked at ABX, and ABX was on a major support level on a monthly chart. I'm going to go to a monthly chart on GLD, and you'll see that, yes, it is in fact, it has a half signal this month with a higher low than last month. Yes, remember, the candle is still red for this month, but we have a higher low. It's slight, but it's there. We have a higher low on the monthly candle, and here we are with a week and a half to go. It does not look to me like gold is going to show volume that will surpass last month's volume. So, like we mentioned before, lower volume with red candles is telling us that the sellers are becoming less motivated. Here, 1, 2, 3, 4, 5, 6, 7, 8. 7 out of the 8 months were significant red candles. We now have lower volume on a red candle, and we have a huge divergence from the moving average. I'm still very bullish on gold. I have to disclose this, that I am still buying gold on every new buy signal that I can get. Here's the weekly chart, and this week already we had a big up move in gold, which is still a higher low than it was last month. We have gaps above the market here. You see that? Up over 160, we have gaps on the weekly chart. Gaps on a weekly chart on gold, almost 100% of the time, gaps on the weekly chart fill. Almost 100% of the time. If you go back and look over the last 25, 30 years, almost every single gap in gold on a weekly chart is filled. The only one that remains open is this one. So I'm still very bullish on gold, at least up to the 162 area or around that gap fill point. And that's how I feel about GLD. Looking at silver, I'm going to go back to the monthly chart on silver. SLV is the ticker symbol on that. And please stay tuned to the weekly market report, because I am going to start commenting about these two regularly with the overall market. Here is a 10-year monthly chart. Let me get rid of some of the lines, and I'm going to show you exactly. Excuse me. I'm going to show you exactly how I drew this. I'm going to drawings. I'm going to price level. I'm going to take that high. Why am I taking that high? Anyone answer that? Let's see. Why am I taking that high and I'm not taking that high? Can anyone tell me why I'm selecting this one and not this one? I could select either one, but why this one? Let's see. Anyone answering? No? Let me draw it while I'm waiting to see an answer. Okay. The reason I'm selecting this high is because it's closest to this low. And lo and behold, that is a role reversal support level. You see that? Actually, I could even draw it exactly. I was a little bit low on that one. I'll zoom in a little bit more so you can see exactly how I'm doing that. I'm going to take that very high right there, and I'm going to click on my line. Boom. See that? Now go over. Here is where the resistance was broken, and look at that. This week, we bounced to the penny off of a resistance area that was established back in 2008. That was March of 2008 that resistance area was established. It broke through the resistance right here in September of 2010, and this week to the penny, it's forming a hammer pattern. Very, very bullish signal. Hammer patterns, especially on a monthly chart, bouncing off the key support level, significant. So I am expecting silver to go up to just under the $30 area right there. From 22.28 up to 30 is a significant percentage return, and that's what I'm expecting to see in silver. Now remember, as I wrap up today's session, historically, gold and silver, even the silver and gold stocks, like Silver Wheaton and Barrick Gold, they tend to go inversely, or they tend to be inversely related to the Dow. So if we're expecting a sell-off in the Dow, the S&P, the Russell 2000, what could we expect for gold and silver if it's the opposite? Well, I could expect a rally. So that's one of the reasons why I'm so well positioned on the long side with silver. My last purchase in silver was $22. I have a strategy to buy it every dollar down as a long-term investor. I'm not trading it. I'm accumulating it. I want silver. I do believe that inflation one day is going to come back. It could be 5 years from now. I don't care. I want to be hedged against inflation, and the precious metals is the best way to do it. So, again, just to recap, if If you're interested in learning more about the signals that I mentioned in today's session, go to the Market Guys website, go to videos, click on the market shots, and just start going to town on those. You will be able to get a lot of information on that and how to trade. If you're interested in mentoring, just put your phone number in the Q&A box, and I will be sure to call you by the end of the week. And if you are interested in subscribing to our weekly free newsletter, which is the weekly market report, all you have to do is put your email address and first name on the website, which is right there in front of you on the front page. I want to thank everyone for joining me for this wonderful hour. I hope you had a good time as I did. I really enjoy this each and every month, and I hope you tell everyone about it because, listen, this free education, can't beat that one, especially when it's helped you make some money each and every month. So have a great evening. We'll talk to you soon. So long.